Welcome back to another great podcast with Plan Your Federal Retirement. I'm your co-host, Micah Shilanski, and with me is another awesome financial advisor joining in from Washington, Christian Sakamoto. Christian, how's it going, bud?
Micah, it's going well. Great to be back on the podcast. How are you doing?
Man, I'm just getting super excited. We got March is here, so that means we are getting ready for tax season. Reviewing dozens, dare I say, hundreds of returns would be a fair statement. What do you think?
Yeah, we've got a few hundred of those clients that we got to review tax returns for.
Yeah, and this is something that we enjoy doing. Now, it's a bit of a crunch, right? But one of the things, and I don't want to take anything away from a tax preparer, CPA, et cetera, they do a fantastic job. They get to work with a client a very limited segment of time and get all the data from the client that they think they need, put that information on the right line on the tax return and get that produced. Whereas when we get a look at a return, a couple of things is one, we get to review it because we didn't prepare it. We can review it a little bit better. It's like when I try to preview and write my own articles, right? I can't be the one that reviews the articles because everything I've written, I read it correctly. I don't find the mistakes in there. You got to hand it over to somebody else to really see those mistakes. Christian, do you find that same thing?
Yeah, 100%. I'll write something, I'll make a video on something, and I get some good feedback that I just wasn't looking at from my own perspectives. I think everything I do is great, but it's not true. So
you think everything you do is great. Humility is high on our list. Fair enough. All right.
What I do when I review tax returns, same kind of thing. We've seen little things, and then we've seen some pretty big ones that we ended up having to go back to the CPA for and just saying, hey, look, we missed this, and this is something that we really want to make sure is on the tax return for. And so I think it adds a lot of value just to have a second opinion on that. Not opinion, but just a second review on the taxes.
Second set of eyes, right? And it's another benefit that we have is we get to work with a client all year long versus, a 1 hour engagement to prepare the return. We get to see a lot of things with the client and know what's happening, et cetera. We've seen sales get missed of one client when they're selling their business. It got missed. I don't know how it got missed, but it got missed on a tax return. We've had pensions get missed. We've had the last pay stub get missed. There's a common one that I would see happening for anyone that retired on 12/31 of last year, of 2021. They retired, but Christian, they still got a W-2 in 2022, right? Because when the leave was cashed out in the 2022 tax year. So you're going to get a W-2 on that. That's one that's commonly missed because you think, I've been retired the entire year. I'm only getting a 1099-R. You are mailed a W-2, but maybe you moved, maybe you weren't looking, something of that nature. And that's a very easy one that you could miss.
Yeah, absolutely.
All right. So I know I would be fine geeking out all day talking about taxes, but this whole episode that we want to talk about today is costly mistakes. And these are things that are not coming out of a laboratory of theory. These are things, dare I say, are coming from the trenches. Christian and I meeting one-on-one with clients, helping them review their retirement situation, everything that's going on in their life. And these are constant mistakes that we see. That's why we want to talk about them, right? We're not perfect. There's always areas to improve. There's always things that we can be doing. And we want to share more of this information because we have a goal of helping more than 1 million federal employees with their retirement. So we need your help. We need you to share this information, get it out there, let more people know about this. Email us in with ideas and things you want us to talk about because it's really important to get the message out. We want you to get the most out of your benefits. But Christian, in order to do that, you got to not make costly mistakes, right?
100%. I'd say let's get right to it then. The first costly mistake that we see is net versus gross, right? And this ties well into our cash flow planning that we do with our clients. And what we talk about on the podcast is really having a good understanding of what are we earning, what money comes in the door every month, and then what are we actually spending from that net income. And again, it's key that it's net income, right? Because net income is what we actually hits our bank account and what we actually get to spend. And so as we're planning our clients' retirement, one of the things that we were always talking about is net versus gross on their FERS pension or on their FERS supplement, right? Same thing with any sort of TSP distributions and retirement distributions. We always have to think about it from a net versus gross perspective.
Christian, I agree 100%. Now, this can be a couple of different ways, right? One, you could make this mistake because you could look at your FERS pension And let's say you had a 37-year career, right? Your pension's $6,000. Fantastic, right? I mean, kudos to you, but that's not what's hitting the bank account. You got survivor benefit, you got taxes, you got health insurance, you have life insurance, maybe long-term care insurance, right? We have all of these deductions that are going to come out that's going to lower that. So that's one simple area that nets versus gross gets messed up. Here's another area that you may not be expecting. Whenever we work with clients, we always want to talk to them in net dollar amounts, how much they want to spend in income. We had one client that we were meeting with recently, a new client, and they were like, hey, we want to spend $150,000 a year. Okay, great. 150 grand a year, 12, ish $1,000 a month, kind of going through there. And then as we start looking at it, they're nowhere near spending $12,000 a month right now. So when we had that initial call with them, we were chatting with them, and I said, well, I need to replace the income I have now. And the income I have now, my high three, my pay now is 150 grand a year. So I can totally see where they're coming from, right? Even in this podcast, we talk about replace the income that you have. They're like, sweet, I'm going to listen to Micah and Christian. I'm going to replace the income I have. It's $150,000. So I totally get that. But what we're talking about is replace the net income. And here's why. Because Christian, as you already know, out of that 150, we had a whole bunch of deductions that will not exist in retirement time, right? The TSP funding, that's a simple one. You're no longer going to be putting money in your TSP account. That's almost $30,000 now you could be putting inside of your TSP account for your contribution plus your catch up. It's fantastic, but that's 30 grand right off the top. So it brings us from 150 down to 120. Plus there's other deductions as well. And so we got to be looking at this from a net perspective, spendable money. How much do we want and where is that coming from?
100%.
I love it.
Well, let's move on to the next one.
Oh, sorry, a little bit of a lag. Christian, go ahead.
We're too excited. So the next one we were talking through was your service comp date, your SCD versus your retirement service comp date. And this is one that a lot of times gets confused as being the same, because on your LES, your leave and earnings statement, oftentimes it'll show what your service computation date is. And so people will look at that and they say, great, this is when I started, and they'll plan they'll base their retirement, when they can retire, off of their service comp date, their service computation date, SCD. Well, not all the time, not 100% of the time is your SCD the same as your retirement service comp date. And those can sometimes be different depending on if you had breaks in service or temporary time, seasonal time, that sort of thing, maybe some military time. So there's lots of different reasons where your SCD is different from your RSCD. And that could be quite costly, especially if you're saying, well, I'm going to retire at 57 years young, and I know by then I'll have 30 years of service, and you're basing that off of a particular date. Well, what happens if you go to retire at 57, but it turns out based on your retirement service comp date, you only have 29 years or 28 years? Well, there's gonna be some issues there. So we just really want to make sure, and can't stress it enough, to really have an understanding of what your retirement service comp date is.
Yeah, and these could be little things that you're like, well, I know I got credit for it because I paid back and I bought my military time, right? Well, fantastic. Does your agency know that? Does OPM know that? And you're gonna be like, Micah, of course they know it. I went through my agency to buy it back. I had to send OPM the check. They had to do this big calculator. Sure, they got the money, but do they really know it? Is it part of your EOPF, your electronic official personnel file? Is it going to be included in your retirement application, right? These are things that we have to look at. And Christian, you're 100% right on. We have seen more than a few people come to us that have a difference in their SCD versus their RSCD. In fact, I have seen dozens of people that have come to us, and I start chit-chatting with them about their federal service, because when you come in and meet with Christian and I, one of the things that we're going to talk about right away is I want a timeline of your federal history, because every now and again, and it happens more often than you think, we're going to find something that the timeline doesn't add up with what their RSCD says it is or their SCD says it is. Sometimes, Christian, we've even found people in the wrong retirement system. I got someone thinking they're in a FERS, and I start doing the math, and everything they're telling me, it says, you are not a FERS employee. You are a CSRS employee or a CSRS offset employee. You are placed in the wrong retirement system. That's under FERCA, a different set of rules. So this is why this is really important, because we want to discover this, Christian, as you already know, but we want to discover this while you're employed. Because if we wait till after you've retired, now we're dealing with OPM. And I jokingly say, when you're in, you're a guest, and when you're out, you're a pest. And you could be saying, well, Micah, it's a pain in the butt to deal with the systems right now. I promise it's a lot more challenging. Here's one thing that's challenging. You're not getting paid. You don't have income coming in, right? Not even an interim check, not even an estimated check, because all of a sudden everything got messed up in your EOPF. OPM doesn't know what to do. I've seen delays 8 months before an interim check started. We just had a client that everything was pretty much in order. There was a couple of caveats inside of their pension that we knew were going to take longer. It took 12 months for them to finalize their pension. Their pension's over $8,000 a month, and they were only getting an estimated check of like $1,200 because OPM didn't know what to do for 12 months. So that's why these things matter. Is I'd rather sort this out while you're on full pay and you're working, and let's get it as clean as we possibly can before it goes to OPM.
Yeah, good point.
All right. I would definitely say the next one is on retirement rules. And I know we get a lot of questions about these. I do a lot of first federal fact checks, Christian, I think you do as well, on the rules of benefits. So MRA and 10, postponed retirement, deferred retirement, FEHB 62 and 20, right? 60 and 20, all of these different rules that are going to be there. And so the biggest thing I'm going to say with this is you have to understand what the rules are and sometimes understand what the exceptions are. Because Christian, one of the things that we like to talk about is it's not just the rules, right? But it's the exceptions to the rules. In fact, we were chatting with a client today that was working with an estate planning attorney. This doesn't pertain to federal employee benefits directly, but they're working with a estate planning attorney. And estate planning attorney was like, no, these are the rules. This is the way it has to be set up. This is what you can do. Well, I guess the problem was they weren't an estate planning attorney. They were an attorney that was doing estate planning. Okay, so there's the distinction. They didn't do this all the time. And Christian and I are like, no, that's actually not the rules. Yes, that's a rule, but here are the exceptions to that rule, and we qualify for an exception. But it was just blowing the attorney's mind because it's not something they do on a frequent basis. So this is something about these the military retirement rules, but retirement rules, MRA and 10, FEHB 62 and 20, et cetera, and exceptions. You got to know what the rules are, how they apply, and you got to know what the exceptions are, and really well documented those exceptions if they apply to you.
Yeah, 100% agree. So let's look at the next one. Ignoring changes in insurance needs when retirement comes around, right? This one is really important because we have to see when it comes to insurance, we're talking about life insurance, we're talking about health insurance, we're talking about long-term care planning and insurance as well. So it's really good time before you retire to have that discussion to say, what are our needs moving into retirement? When it comes to life insurance is one of those questions that we're simply asking the question, do we need it or do we not need it? And if we go through sort of this scenario, we say, okay, God forbid one of us passes away, what's the other spouse going to be left with? And we add up the pensions, survivor benefits, and TSP distributions, and all of that looks good, then great, we don't need life insurance, right? As an example. And if the answer to that is, well, we don't need it, but we still want it, okay, that's another discussion. But we need to have a really clear understanding of our life insurance needs, as well as planning for long-term care. As we're working, we're young and we're healthy, and we're working throughout our career, life just catches up and we start to not really take time to think about the future when we're in retirement and what our health will look like in the future. And so long-term care planning is another one that we really have to stress and have a plan for. It doesn't mean we need insurance per se, but we just need to have a plan, because as a federal employee, you have access to the Fed long-term care plan, which temporarily is suspended. I know that, but at some point, you'll hopefully be able to have access to it again. Could be a useful tool. We want to make sure that you have full knowledge of all the insurance that you have as available to you. Same thing for your health insurance, your FEHB, making sure we have a plan for transitioning to retirement, and eventually, once you're of 65 age, looking at Medicare. We've done lots of videos, podcasts talking about signing up for Medicare Part A and B in a lot of scenarios, and there's a cost to waiting if you do not follow directions and don't sign up at 65 for Medicare. And what we would want to do is avoid those costly mistakes simply by just understanding those rules a little bit better when it comes to Medicare.
Yeah, the 100% correct. Really understand what these rules are. Now, keep in mind, whenever we're talking, I like to say risk management, right? It's my fancy way of saying insurance. You need to have a plan for all of these things. That doesn't always mean you have to have insurance as the solution, right?
Right.
But we got to have a plan. God forbid a spouse dies. What's the plan? Right? Do we have beneficiaries up to date? What do we have in place? You know what? What if it's a spouse that normally pays the bills? We were talking with another couple today, and one of the things is one of their friends' husbands passed away. He did all of the finances in there, didn't have anything documented whatsoever. Now the wife's trying to pick up the pieces. She doesn't even know where the credit cards are, right? She doesn't even know this information that's out there. These are real life things. So we got to have a plan for these. We're not just saying get insurance. That's not the point. What's the plan when a spouse passes away? What's the plan when you have a medical crisis? What's the plan if you need long-term care? Like, what are you going to do? Insurance is a tool that can be used to help or not help, but I don't even care about that in the discussion. We always have the discussion, what's the plan? Long-term care. Are you going to stay at home? Who's going to take care of you? I like to pick on my parents on this one, right? My dad, was talking about, well, I'm not moving into a home. I'm going to stay here and blah, 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 blah. It gets real emotional about it, right? Now, he's a financial advisor. He's a smart guy. He taught me everything I know. He's an amazing man. And we started having this conversation. And one of the things that I talk about with him is saying, well, great, you want to stay at home. You're 220 pounds and mom's 150 pounds. How is she going to pick you up and put you in bed, right? So you get this whole plan about staying at home. How's that going to happen? Right. So we need an option that's going to be there, of a plan that's going to be in place. Then we can have discussions about insurance at a later time. So that would be something that's really, really important, etc. And then, Christian, I'm going to say kind of transition. All right, get off my soapbox of the death and dying for just a minute. The other part thing is working in retirement. I'm going to say this is another one that some mistakes can easily happen around working in retirement. One mistake that sometimes happen is we have one spouse that pulls the other one into retirement before they're ready. And this is definitely a mental aspect of things to be thinking about, right? About saying retirement is not just a financial issue. It is a mental issue. Am I ready? And guess what? Some people are still giving back. They're still at a point in their career that they're not ready to stop regardless of the finances. So we got to have this conversation about how that's going to work. Sometimes you got one spouse that's retired because they're older, really wants the other one too. Okay, great. That spouse is going to retire, but they're not done yet. We need part-time work for them. They need to be engaged in a social project, right? They need something to do. We can't just stop. So one, you got the emotional side of it, but Christian, there's a lot of other financial things about working part-time too, right?
Right. So as you know, for our listeners there's the FERS pension, and then there's also a component of it, the FERS supplement or the Social Security supplement, different names for that same thing. And that benefit goes away, that FERS supplement goes away or is phased out rather if you end up working after you've separated from service, or rather retired and are receiving it. And the threshold for 2023 is I think 21,240 off the top of my head. I think that's the number.
Yep, I think you're right.
So that would say if you make more than 21,240 of earned income, meaning you go and you work another job after retiring, that slowly but surely are going to start taking $1 away for every $2 earned past that number. So we just have to make sure we know that rule. If we're used to earning our first pension plus our first supplement, that if we go and get another job, that could possibly be reduced depending on how much income you earn from that second job. But the other one is talking about kind of on those same lines. I've had recently a conversation with somebody who was going to be a contractor or was offered a contractor position, and same kind of situation where they would leave service and receive their first pension, then of course their supplement, but that supplement would go away because they're a contractor. However, we've also seen cases of phased retirements where that phased retirement, if we're not clear on the rules, basically if you're earning a certain dollar amount from this phased retirement, but then you're also receiving your pension at the same time, that can get offset, and then you end up not really earning all that much more money for doing a phased retirement. So curious your thoughts on those. I'm not sure if I'm a huge fan of the phased retirements if we can avoid it. However, from my perspective, contractor positions could be pretty lucrative.
Yeah, and that's only looking at it for not saying this negatively, but that's looking at it from a financial standpoint, right? When we look at the
Yeah.
financials, I can't make a phased retirement work. Now, here's some reasons that someone might want to do it from an emotional standpoint. Your agency won't rehire your position until you leave. And you're like, hey, this is a brain drain, right? I'm going to separate from service. Then you're going to hire my replacement. This doesn't make sense. So I got some people that says, you know what? Regardless of the finances, I would rather do a phased retirement because it allows my agency to backfill my position. Now I can train and mentor that person and move on. That's the theory. Reality doesn't really happen that often, but I can see that from a concept of things of, hey, wanted to make sure that that institutional knowledge wasn't lost. Okay, that's a great way for a phased retirement. Second way for a phased retirement that mostly works is it has deadlines with it, right? So it's not like I can be on phased retirement for 6 years. It is when you start phased retirement, there's an end to when you were going to be fully retired, depending on what you agree with your agency and OPM setup and all those other things. So one of the nice parts, again, from an emotional standpoint, if you have one spouse that's like, hey, I'm retired, I want you to join me, and the other spouse is like, hey, I'm not ready yet, phased retirement actually puts a line in the sand of when they're going to be stopping working. So sometimes, again, emotional reasons here, but these are real reasons for retirement. There's those two elements we've talked about. There's the emotional retirement and financial, and they both have to be in line for a successful retirement.
Makes sense.
I love it. Some other things that just really kind of come up as well, tax code, not understanding and really applying tax planning to your federal retirement. I know I get geek out on taxes. Forgive me, just bear with me just a little bit. But we were even chatting with another client today. And one of the things we're talking to the client about was taxes. They've done a great job in saving money, which is fantastic. I absolutely love it. But they even said, oh my gosh, when 73 comes, because now RMD's required minimum distributions are at 73 for Secure Act 2.0, right? So at 73, they're like, oh my gosh, these RMDs, I'm going to hit Medicare limits. I got to do this IRMA. I'm going to have to pay all this more money, et cetera. I said, hey, great news. You're thinking about it. I love it. You're already thinking about it, but we have to do something about it now. Kind of their I don't want to say their plan, but kind of what they were thinking is it was just going to happen to me, right? Because I don't really need the money. I wasn't really going to take distributions. I was just going to let my money grow. Then I have to take these RMDs at 73, which that is an option. That's generally not something we recommended. And Christian, one of the things we're working through on the numbers was saying, hey, maybe we, for the next couple of years, massively trigger IRMA, do huge Roth conversions today in order to pay those taxes and be done. But then you're going to be done with IRMA. Now you're going to be below the threshold. Now the RMDs aren't going to be what I call punitive. I consider an RMD punitive when it bumps you into another tax level, whether that's an additional Medicare tax or a different tax bracket that we weren't expecting. That's now punitive. It's not helping me. So we got to be a proactive with these things. And so looking at that 10-year tax projection, how much money am I going to make? Where's that money going to come from? How am I proactive in my taxes? You know, if you got 30 years left in your career, fantastic. What are you doing today to lower your 30-year tax bill, not your 1-year tax bill?
Absolutely. And coming down to, again, the choice is when it comes to tax planning, the default is not doing something, right? That's always the default, is just do nothing. But that can have a negative impact. And so having the foresight and really understanding the tax laws to say, okay, well, if we do nothing, here's where we'll be. And then eventually we're going to have to take out money because of those required minimum distributions. And then, well, what if on the flip side, we did something about it now? And essentially that's the Roth conversions. Or for our younger listeners who've got many years ahead of them, just looking at the taxes today and asking the question, do we think taxes are going to be lower today than what they will be in the future? Right? Do we think that if we're younger and we're working, do you think our income in the future is going to be higher than it is right now, than what it is right now? So maybe it makes sense to be intentionally paying taxes at a lower rate than what we think they'll be in the future.
Absolutely. Well, Christian, this podcast is all about action items for our listeners. So really important that we don't just have a great time, right? That's usually important. I enjoy this. We're sharing some great information, I think, but I want you to take action on this that's going to improve your life. So I'm going to kick it off, Christian, with the first one, which is know your retirement rules. I'm not asking you to know every single rule inside of the federal retirement book, right? That's Christian and I's job. We got to know and understand these things pretty well, but you need to know what the rules are for your retirement. what time counts, what doesn't count, how's your high three comes to mix, can you really retire what you think you can, right? And I'm not looking for water cooler information. I'm looking for information from OPM that says, yes, these are the rules. So that's really important.
Yeah, love it. Second action item, share this with a friend. We have really ambitious goals like we've shared. We want to impact 1 million federal employees to help over 1 million federal employees retire. So please share this with a friend.
Yeah, get this message out. I love it. Third action item that we're going to have for you this week is know your cash flow. Understand your cash flow. What are you waiting for to do a good cash flow plan? So often I talk with people, which is fantastic. I love talking with federal employees. It's so much fun. But one of the things is, Micah, I've heard you talk about this for a while and I just haven't done it. Why not? Cash flow is the heartbeat of retirement. Cash flow is the way that we know if we're going to have successful retirement, do the things we want to do or not. And that starts with knowing our cash flow today. I know it's not super like sexy and cool and, oh my gosh, I can't wait to get cash flow planning. I get it. But it's key. It's essential. It's one of the things we need to do. And you don't have to make it super complicated. I'm not talking about a budget with 72 different line items and quickens and downloads and all these fun things. I'm talking about a simple cash flow plan. Now, if you don't know what that is, jump on our website, planyourfederalretirement.com. Check out one of our episodes on podcast where we talk about this cash flow plan and we walk you through step by step on how it works. Well, Christian, as always, I enjoy putting this information together. So thank you so much for joining us. And until next time, happy planning.
Happy planning.